Hey everybody, it's Michael Martin. Hope you're doing well. Hey, so I was just chatting with somebody on a call, and they talked about using a two ATR stop. And every time I hear two ATR stop, I'm thinking this is a fear-based trader. And why do I think of that? Well, you know, you have to first choose your R. Like, what is it that you're willing to risk on any one particular trade in order to be in the trade in the first place? So let's say we can choose. Uh, one half of 1%, assume $100,000. The client wants to risk $500 per trade. All right. Now, here we have a chart that's breaking out to the upside. Who knows if it continues? DraftKings. And you can see the 20-day ATR in the bottom here is $1.58. So if we chose, $3, right, and 16 cents now, which would be two times the ATR, now we're making our position size half as much. Right. So now we have a smaller position, and now we need to see the thing move $3.16 just to make one half of 1% on our account. So then you go back and you take a look at the math and you say, okay, the thing has to move, almost 10%, or, it's not exactly 10%, but I'm just eyeballing it here. Like, what do you think? Right. Let me just do the math. Yeah. So it's about 6.7% in the underlying to make, one half of 1% to your portfolio. And so all of this is probably is very intuitive for you to think about right now. What I want you to think about though is, and comes back to this was a coaching client, someone who's doing the online program who wrote in, and I record, I answer video answers for them using a video program. And I said, look, the first thing that we study in the psychological part of the program are goal setting, our goals. And it's not like I want a Ferrari, I want to live on Central Park West, I want to have a home on Cape Cod in Hyannis. Those aren't goals. Those are all like the runny nose of a bigger issue. Like acquiring stuff is not a goal because you can probably do that either with cash or credit right now. So the goal should be to grow and amplify your account, right? Even saying something like, oh, I want to be a profitable trader. Since there's no time lane on that, to me, that's a very flaccid goal. It's probably one that's not going to get hit. And again, I was just dumbass luck in that I knew I needed to take my 5K to 25K because I had no breathing room, right? Which is, lucky. I was lucky in a lot of ways. I grew up in the Northeast in New York where we had a crop year. So I understood physically settled commodities. I wasn't really any good at trading stock index futures, financials, or currencies because I couldn't see them. You know what I mean? And they all seem to be super, super hypersensitive to like, if the central banker farts, somehow the Deutschmark would move 0.5%, And so I was like, I don't have time to follow all this crap. If you listen to the last episode, my Clark Kent kind of job was that I had to be a financial advisor so that I could keep the managers off my back while I really did what I wanted to do, which was to learn my craft, learn how to trade. So having said that, I want you make sure that you know what you're doing it for. What, like, people would say, like, what's your why? Well, I'm doing it for my kids. Okay, well, that's good, but the relative strength of loving and hating your kids, trust me, could turn on a coin toss. So, what is it that you really want? How do you want trading to serve you? Because saying like, oh, I just want to make money on this trade, like, who cares? Like, who is like betting on the Jets or the Giants? So the more clear you get about your goal, the more likely you are to hit it. Now, you also have to kind of phrase it instead of saying like, I am going to be a profitable trader. That's also not a good goal. And think about it for a minute. You're using the future tense. When is that going to happen? I don't know, someday. Well, in my experience, someday never really comes. Someday turns into every day, and 3 years later, you're 25 pounds overweight, you've lost all your hair, you're working a job that you don't like, and you think you're making it as a trader because you're putting 3-4 hours in every day. But the truth is you're pissing in the wind and shoveling sand against the tide. That's the norm. And those are the people who are working under an alias on Twitter or StockTwits and are hammering away on their keyboard, pissed off at everybody because they're working their ass off and they think they're entitled to stuff and they're not. And it all comes down to their lack of clarity as far as their goals are concerned. Because I believe with the neuroscience and how much everybody knows about neuroscience, you can get whatever it is that you want in life. You actually get what you think about. Your physiology actually changes. And again, I was very, very lucky to be born in the environment that I was, with the parents that I had, and under the duresses that I had, because they really shaped me. There wasn't there wasn't room to go anywhere. If I was struggling as a trader, there wasn't another Discord that I could go to. There wasn't a place where I could go online and get free stock tips. There was online video. I remember AT&T had a they said someday in the future you'll be able to do video calls, and I was like, "What?" Because I'm still dialing with a rotary phone. And who the hell knows how they knew that there'd be video calls, or that you probably needed a satellite to get that done. So I want you to just stop what you're doing for a minute and actually take inventory of all your behavior, because the behavior predicts where you end up in life. And if you're not acting intentionally, you could be just doing a lot of busy stuff, right? That's not really getting you anywhere. So if you're going to use 2 or 3 ATR, then that's great, but make sure you got a 5% risk unit. Like, make sure you're going to make some money on the trade, because what that typically says to me is that you're trading to not lose, right? Another way to look at it. If the S&P does 9% total return, it was 12 and a quarter when I started, just to give you an idea. So those people in recent years aren't getting the 12 and a quarter that I didn't promise to them, but I said that's what it does on average. It's now doing 3/4 of what I told them it was going to do. So if you're doing like 12, 15% taxable, but you're spending all day to do it, I would say look at it this way. You could invest in the S&P or the QQQ or a blend of both and get all your time back. You see what I'm saying? Now, if you're running 10 million already and you can get a lower, 3, 4, 5% drawdown compared to buy and hold, then yes, you might be onto something, but you're already rich, so it's not a problem. But make sure you're getting paid, right? You can position size this thing. I knew a guy who was like, he'd buy the underlying here, he'd buy the 46 puts, he'd write the 50 calls, and he's choked out the trade. Like, there's no way for him to make any money here, because there's so much fear. He's got, collared using, tradable options, not even over the counter options, which is how, they really put collars on large, $4 million positions. He's paying the bid ask spread, and he's just choked out, and I don't get it. It's like, what's the point of adding the risk if you're in so much fear? Like, there's other ways to make money that you have more safety, better tax treatment, generate cash flow. Think about real estate, right? So when you look at ATR, it's very, very objective, right? ATR is the average true range. You can look at how they come up with the calculation. For the day's range, there's 3 calculations that, go from yesterday's close to today's high, yesterday's close to today's low, and then they take the intraday range, they take the absolute value of all those 3, each of those 3 calculations, and whatever the largest one is on an absolute value basis becomes the day's range. Then they throw that into a moving average, and there you go. So it measures volatility on average. It gives you, like, I call it the personality of the instrument. It kind of gives you an idea. So now you can do the math and see, like, okay, well, I got $1.58 on the underlying. And so this thing trades at about 3 1/3, right? That's about the volatility, about 3.3%. So this might be more volatile than certain commodities if you look at it that way. But the point is that if you use this to position size and also calculate the distance between, your entries and your exits, you need to know, like, okay, here's where I'm going to add to my winners, right? Because if you're doing 2 ATR and then you're selling half at an ATR and then raising your protective stop to break even, you're doing a lot of busy work for no money. And if that feels good, there you go. That's probably why you're doing it. So, I don't it's not to be critical, it's just to shine the light on, how you might be doing things in your account and why it feels like a grind. It's because you've deliberately set it up that way, right? If when people come to me and say, "Here's what I'm doing," and they spell it all out just the way that I explained it, my first reaction, because I don't know them, I don't know what they're trying to achieve, is like, "Okay, what's the problem?" And they're like, "Well, I'm not making any money." And I'm like, "Well, that's the way you've designed it. You've designed this thing so that you can't lose any money. And if you can't lose, you can't make either, because risk and reward go together. They're like perfect complements, right? You need the risk in order to make. So make sure that when you put on a trade, are you trading to not lose, or are you trading to actually make money, right? Because there's a big difference. And you don't want to let fear dominate you, not just in your trading, but in your life. You always have to dance like no one's looking, right? Go for it no matter what. So the big takeaway is act purposefully, intentionally. What is it that you're doing all the trading for? It's okay to have a general sense of fear, in that you have to respect the risk for sure, but that's as far as it should go. You can't be, micromanaging the trade, or start to like trade or off of weekly or daily charts. And then once you're in the trade, you start looking at 1 minute bars because you can't take the heat. If that's the case, it might not be a good fit for you to trade, because you have to have a certain appetite for risk taking. That doesn't mean gambling, and it doesn't mean at all be reckless, right? Now, so much of this is experiential, where you kind of have to figure it out on the fly. Yes, you can use a simulator to see if you have edge on what it is that you're trying to do, whatever particular strategy. Edges can change. First of all, it can change over time. Things that might have worked 20 years ago might not work now. Um, they don't generally turn on a dime and stop working. Like they worked yesterday, don't work today. Um, there can be changes, though, for sure. Um, Trying to test things at the portfolio level, not just on one name. Like you can go back and obviously curve fit something and Bitcoin, and turn, $1,000 into 17 trillion with all and the data that you can get access to. It's not terribly practical, but you want to make sure that your rules are robust enough, in that they would work, say, on all large cap stocks, for example. Um, and that's what makes this thing tricky, is that you can overthink stuff and put yourself in such a spot where, you're kind of, you're in this ready, aim, 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 and you're afraid to take a shot because you're afraid to lose. If you need to hear me say it out loud, losing money says nothing about you as a human being. 2, losing money says nothing about your level of intelligence. Why? Because it's like hitting a baseball, or shooting a golf ball, hitting a golf ball at the drive. Like when I was a kid, and I played at a golf course that was about 20, 30 minutes from my house, I could go to the driving range and just hit ball after ball after ball. I could hit them at the ranges of the country clubs that I worked at. That was a perk. I'd have to go shag my own balls, of course, but with that repetition, that muscle memory, and trading is very, very similar. Like if you practice the thing enough, you can develop an ear for trading, and start to see instances where, right, that you can bet bigger or bet smaller. That will come in time. I think it's a lot to ask of people, to think that they need a playbook, 3 months into the game. I think that's a lot, because there's just not enough time to develop the a posteriori and after the fact knowledge. You can simulate all you want, and that's definitely helpful. But it's like, you know, uh, doing it and feeling the burn and invoking whatever emotions might come up for you when you're managing risk is really invaluable. And you can't simulate that in a lab, right? Um, so my advice to you is, make sure you know what you're doing the trading for, and that if you do, like, why do you choose 2 ATR or 3 ATR as your risk point? Why wouldn't you consider like a near-term low, or a swing support level, like below the market, for example, if that in fact can help you improve your exit if the trade goes against you. It might be less than the $1.58 that we saw actually on the chart, you see? So put some thought into it, because what you save at the ideation and at the goal setting level can save you hours and years of work going forward. Because if you're in an accuracy world, you might just want to be winning on all your trades, which is not, it's not practical, it's not realistic. You can do that I know guys who found themselves trying that for years, and they just couldn't let go. And in the not letting go, they actually had themselves all bound up, and it caused emotional and psychological issues, and it effectively drove them nuts. And it was very, very hard to recover. Anyway, if you want a free copy of my book, The Inner Voice Trading audiobook, you can click the link below. You can get it. You can also reach out and suggest a topic for the show. Thanks for being here. I'll see you next week.